Hello, this is Dr. Janice here, and of course this is accounting, grade 12, and it's July 2015 here in Subang Jaya, Sailors College CPU. So let's go. What we've been looking at is Unit 1, and as you can see, I've been using, to me, the best resources possible. I'm going to try to finish up by using Chapter 1 in your textbook, and remember your textbook is by Harrison and Horngreen. So just to let you know, Unit 1, which is basically chapters 1, 2, and 3, we're going to be spending a lot of time doing some of the basics of financial accounting until the middle of September. So it's going to be, we've got a few weeks to get a hold of this material. Do not be concerned if you don't understand everything at the very beginning. We've got plenty of time. And remember, the best way to learn accounting is to focus. So make sure you've got no distractions, and we'll have this going. All right, so here we are, and let's go to our textbook. So our textbook, basically we covered a lot of this in class, so I'm just going to go over very quickly in this 15-minute video. So again, accounting is important because it is the language of business. And remember, we talked about that internal use is managerial accounting and external use is financial accounting. And we are taking financial accounting, so we're going to be looking at preparing financial statements that are being primarily used by external stakeholders in the business. We looked very briefly over the forms of business organization. There's 3. Remember, most people start off very, very small. They dip their toe in, and I gave the example of a home-based business. So you're the sole proprietor, and the business is you. If there's any problems, and there's legal liability, financial liability, that's you, and your taxes are based on you and your income. When you have partnership and corporations, the business takes a life of its own. Remember, I used the example of Sony, Samsung, Apple, donuts. It's a company on its own with many shareholders who own shares of the company. Partnerships are, for example, law firms, accounting firms, maybe some medical clinics are more partnerships. And so shareholders, this is what you see in big Hollywood pictures, when there's many people and they all have a share of a business that's hopefully growing, like Apple. We'll probably look at that more later on, and as you can see from your textbook, there is something here in the slide that talks a little bit more about it. This is not something you need to know in great depth. If you're taking an entrepreneurship course, it will give you more practice on it. Some people like to be on a board, and that's, if you're in a corporation, you have to have a board, you have to prepare financial statements that are reported to the government. And so, of course, like this is very important. Again, something we covered in class, we looked at GAAP, and now international financial reporting standards are what's really important, so that when you look at financial statements for companies all over the world, they use about, the same format. And so, therefore, interpretation is something that you can do really quickly. Alright, so that was a quick overview. Let's look at Objective 2, and this is where I think, basically, in my previous video, we looked at assets, liabilities, and equity. That is the basic accounting formula. Remember I said accounting is basically beer, A-L-E. We also took a quick look at income and expenses when we used J. Arrow, the accountant, who set up his own business. So, actually, we only actually looked at this first part for the business, which was balance sheet. Income is basically anything that generates revenue for your business. Looking at Apple, Apple generates revenue from basically, I think, the products and services. When the products is the iPad, their iPhones, and now the watch. There's still the iPods, but that's something they're, I think, phasing out. Their service, which they also sell, is for example, the Apple iCare Plus, which is available when you buy an Apple product in certain countries. I'm not sure if it's something that you get here in Malaysia. I don't know in Canada and the United States. For example, I paid something like $100, $200 once I bought my iPad mini, and that gave me basically 2 years of coverage for breakage, spilling, and then expenses. Of course, remember we used the example of Starbucks. So in order to generate money for Starbucks, they have to get the coffee beans. They have to pay for salaries, and these are all legitimate expenses. If you look at this gets sort of like an overview philosophy. I like looking at the guts, but for example, when you are looking at a business, their going concern is when you're preparing the financial statements, when you're looking at the business activity, you're hoping that this is a business that's going to go on and on and on. You're in it to make it alive, to make it go. So you're not hoping to make decisions based on it closing down. So it's a going concern. Accrual accounting means you record things as you go along. It's tracking. So when you're asked you to document things or track things, anything that happens, any activities, any transactions, you put it in paper or on a spreadsheet as you go along. And then the constraint is basically we want to make sure that we pay attention to costs. We're not too free. As a business owner, you want to make sure that you don't eat into your profits. Anyways, so that's just a general overview. Your book goes into a little bit more detail, probably in more detail than what we're interested in an introductory course in accounting. So we looked at in financial accounting that there are people who are external to the company that use accounting information, investors, suppliers, etc., customers, the public, and the government, and then internal information. For example, managers, that's a managerial account. All right, so I'm just going to, there's 40-some slides in here. I've only got 15 minutes, so I'm just going to go around really quickly. You can read all this on your own. Faithful representation, as in tell the truth. Let's see. All right. Okay. I've actually gone over some of this already. And this actually I sort of discovered, and especially with the J arrow. Okay, so applying the accounting equation to business organizations. This I spent time on it in for the first video. Again, assets equals liabilities plus owner's equity, ALE, in other words, beer. So there's a balance. Anything that happens here also has an effect on what happens here. You want to make sure these are equal. As I say, if you focus, you will not have any problems. If you don't get it to balance, I'll just ask you to keep trying. Okay, so let me just go back. All right, so what you saw before was basically ALE, which is the balance sheet. Okay, that has to balance. Now, this one is basically the calculation of, did we make a profit or a loss? Net income is fancy for profit. Of course, there's, loss is loss. Okay. And so how do you know if you made a profit? How did the business do? Well, remember we're looking at the case of Apple. Okay, so Apple, their revenue from the sales of iPods, the iCare insurance, iPads, MacBooks, etc. So they have a total revenue. Then Apple in Q2 of 2015, they also reported their losses. But their net income, or profit or loss, remember it was £12 billion for Q2 in 2015. In other words, they made profit. Okay, so this was a lot less than this, and therefore their shareholders are quite happy. Probably good dividends. So what we have to look at is, just because you make your profit doesn't mean you're going to spend it all. Remember I mentioned that Steve Jobs, he did not believe in taking any of the profits and paying it to shareholders or owners of the company in the form of dividends. He retained everything. But he retained it for good reasons, because he spent the money on R&D, maybe some marketing, paying the employees, so that Apple could continue to be a leader when it comes to consumer electronics. Now, retained earnings. If you think of it like this has an impact on owners' equity. So what it is how when we go into Q2, okay. So what was the position of Apple, for example, at the end of Q1? That's this. Now, then based on the activities for Q2, okay, so generated lots of revenues from the sale, especially of the Apple Watch. Then you subtract their expenses, and then of course the net income for Apple in Q2 was 12 billion pounds. Okay, so that was the position of Apple, which, remember I said something that you were sitting on cash, something like 120 million US dollars. I haven't looked at it lately. It could be more. So then if you add the 12 billion pounds, I mean, whatever it is in American dollars, so 12 billion pounds is 40 billion American dollars. Then if you were like Steve Jobs, you didn't pay any dividends to your shareholders, the owners of the company, then therefore that is the ending balance of Q2, and then you go into Q3. Okay, so this doesn't balance, okay, whereas the balance sheet balances, the income statement, it doesn't balance. So, all right, so very quickly, let's see. So let's look at this as about operations, and this helps you decide, are they efficient or not? So there's 4 financial statements: the income statement, then there's the balance sheet. These are the 2 most expensive, most important ones. But in order to get to the balance sheet, you have to look at the statement and the changes of equity, like the previous slide that I had. And then from there, that impacts the statement of cash flows. So again, the income statement is, did you make a profit and why? Remember, we were looking at some companies, they have their huge expenses. Starbucks, to sell a cup of coffee, the expenses are a lot more than your outdoor hawker stand. Okay. And so that impacts the bottom line. Now here's a copy, here's an income statement. You have, I think on page 2, chapter 1, the income statement for Samsung. So income statements always have the same outline. Okay. Net sales. Net sales is basically, well, revenue. Okay. So sales minus expenses gets you net income. Okay. And so some of the, and we will explore this in detail as we go into Unit 1 into Unit 2. But basically, if you think of it as simple, how much did you make? What were your expenses? And that generates, your profit or your loss, or as they call it, net income. Remember, I said that when you prepare a financial statement, the first thing you do is, what's the name of the business? What's the name of the financial statement? And also the date. So, whereas in a balance sheet, you've got a snapshot of the business at one moment in time, for the income statement, it's usually over a duration or a period of time, and what is the end of it? So this is the end, which is December 31st of 2015. We need to have the year here. So that's very important too. So that's how an income statement looks like. As I say, we'll be going into more details. I prefer having different hyphenations myself, but I mean, that's just my personal preference. Okay. Statement and changes of equity, okay, is basically, is the company, like, how is it more valuable or less valuable? And so this is also a very standard format to it. What did you start off with? What did you end up with? And then what happened in the middle? This video is almost over. We're going to, of course, here's the balance sheet again. And I think actually I'm getting close to the end. Maybe I should just wrap it up here. I'm just going to go back. So basically, when you are doing a balance sheet, it's a little bit more complicated. You have split up into current and non-current, so basically based on liquidity or how important it is and how urgent the payments are going to be. Anyways, this video is over. See you next.